One of the other things that kind of transitioned that is credit became a lot easier to get, right? That little plastic card that came about, right? If you wanted something and you wanted it overnight, well, what do? You finance it. You put it on a card. And then what happens? You take on additional interest. You can buy it now with the idea of, I'm going to pay it off later.
Yes.
But we had a previous episode about this with the whole marshmallow experiment, right?
Yeah.
Delayed gratification. Successful people have delayed gratification.
I'm
If you
hungry.
don't have the means to pay it, why put it on a card with the idea of paying it later? If you don't have the proper money patterns, you're probably not going to pay it later, right? So that's kind of becomes the path of least resistance here. When credit became easier, when it was everywhere, when the idea that you can buy it now and pay for it later, oh, and Amazon stepped in and literally gave you overnight delivery, put everything else at your fingertips, that consumerism. So I don't think it's necessarily people becoming irresponsible. I think it's people having faster access to capital. That's what it was.
Welcome back to another episode of WealthWise Banking. I am down here in the city beautiful Jason Patrick Sipple and with my favorite co-host, Jeremy Lee Huggins. How you doing, Huggy?
Doing well, man. I'm doing well. Florida is heating up. It's getting hot out.
I hadn't noticed. I hadn't noticed. It's been kind of cooler in the morning, so I don't go outside that much these days. I was outside laying in the yard a little yesterday, but it's not hot yet, brother. I'm telling you, it's still kind of cool. So
All right, yeah, let's get open to what is it, Dante's Inferno?
yeah, when it starts feeling like that every morning when you walk out and you're wet by the time you walk out, that's when you know you're in Florida heat. Right now, it's still kind of like fallish. It still feels nice.
Yeah, welcome to the South. All
That's
right,
it.
well, we got a good episode today. This is one of the ones that you kind of had the idea for it. But before we kind of get into it, what sparked your idea for this?
Well, actually, what sparked the idea was kind of working backwards to it was reading a book about the ruthless elimination of hurry. And then when I started studying that, I started finding all these shocking statistics. And I was like, oh my God. And then read something that was said right after 9/11. And I was like, this is an episode. Like, we got to talk about this. Like, there's stuff in here that needs to be talked about, and it'll be right in alignment with what we're always sharing, the difference between borrowers and builders. So,
Yeah, and I one of the statistics that you shared was about what was it, 70% of Americans are living paycheck to paycheck, right? And
yes.
it's if you look at that, that's kind of crazy to me because people are working hard, but they're working really hard. They have multiple jobs, most people, and they're actually their productivity, if you look at technology, has increased far more multiples than their parents ever had, than their grandparents ever had. So why is it that they're actually living paycheck to paycheck? If they're more efficient at the job, why are more people in debt? So one of the things that we're going to get into today is a couple of those statistics that you discussed, right? And then we're going to discuss a little bit about the story on how a lot of people got there, because it's very likely you did all the hard work to not get there, but a system probably put you there in that place. So we want to bring a little bit of awareness to that today. If you are one of those people who feel as though you're living paycheck to paycheck, whether you're making $60,000 a year or $600,000 a year, this is a good episode for you.
Absolutely. And that's what we've noticed, right? We talk about it all the time that when you're listening to this, I would hold any judgment of yourself because we know you're working hard. It's what Americans do. We show up, we hustle, we have side hustles like Jeremy just mentioned. And when we talk about these statistics and we talk about some of the underlying systems and the signs that are there, our hope is that you'll start recognizing those and we're going to show you where you can go once you see what maybe you didn't see before.
Yeah. So what are these statistics? Let's go ahead and get into it. We're looking at 70% of Americans living paycheck to paycheck, right? Gen Z is closer to 72% or so. Personal savings rate. This is a big one. Before we get into that, let's
I was gonna
define personal savings rate.
I was gonna say, like when you're going through these, let's not fire through them because they are all shockingly separate, right? And they all feed into each other too. So you want to define? You just asked me. Let's define savings rate. Is that what we
Yeah,
said?
let's define what personal savings rate means so that some of these statistics actually make sense.
Yeah. So personal savings rate is the money that you're putting aside that is not being used for anything else. So if you put it into an account and you spend it by the end of the month, that is not savings. You want to define it further than that?
No, I think that works out pretty well. All the money that you have left over after the bills, after the mortgage or the rent, right? After the utilities, after even after your investments. Like your investments can be part of a savings rate, but by and large, we kind of exempt those. So what is the money that shows up after you pay your taxes? Like what is your actual personal savings rate?
Yes. And It's less than 4% right now nationally, which is shocking. Not
Yeah.
really, because it's been like that for a long time, right? That's one of the statistics is it's been like this for most of my life now and all of your life, Jeremy. I would go back to when it wasn't like this. It was before you were born, brother. Just throwing that out there. And when you see the only time we've that's actually increased was during when? Was during COVID, during 2020. And that's when everyone was home. The consumption slowed down because everyone was home, everyone's scared, everyone was focused on family, and a whole bunch of money was printed. So you had kind of like this perfect storm where it shot up to like 20% for 1 year. And now
Mhm.
it's back down just a few years later to less than 4%.
To put that in perspective, for every dollar that the average American makes, they're not even keeping a nickel, Jason. They're keeping less than a nickel in their pocket.
Yes.
So 4 cents, 4 cents to the dollar. That's what they're keeping.
Wow, when you say it like that, are they even going to make nickels anymore, Jeremy? Like that's shocking. Like that, not even think of it that way. So that kind of made me think about it differently. So I appreciate that. So
Yeah. So when we're also looking at it, what else is eating up people? We have a basically a people live in paycheck to paycheck. That's almost 3 in 4 people. We have a savings rate that's 4 cents on the dollar, right? What's the other big thing? Credit card debt.
yeah,
That's another.
when we don't have money, when we're not saving and we need something, all of a sudden, we're averaging household of $6,500 per household of credit card debt on average. Some have way more than that, which I know from the conversations, very few have less.
Yeah. And then on top of that, we have rising, skyrocketing student loan debt that's sitting at 1.7. How much? Say that. What was that
One
number?
point with a trillion with a T, 1.7 trillion. Did you know that student loan debt is Uncle Sam's number one asset? Did you know that?
I don't understand student loan debt. I really don't get it. Why someone, how this, this was proposed to me actually this morning. It's funny that how everything happens for a reason, right? Someone said that if schools were made to be co-signers on student loan debt, we wouldn't have so much student loan debt.
That is
So I was
smart.
thinking about that for a moment. I was like, oh, yeah, I guess if you are studying underwater basket weaving and you're taking $100,000 to do that, you might not have the ability to pay it back.
I'll give you an actual study that's just as not lucrative. I was trying to think of another word for it. But I went to school and I have a degree in medical illustration, Jeremy. I don't know if you knew that, but I have a bachelor in fine arts in medical illustration. And when I went to school, I paid $80,000 for that education, right? It was back in the 90s, 20 grand a year, 80 grand. And I made $10 an hour when I graduated doing
Wow.
what I studied. I made more as a lifeguard at 15 years old. Today, my school, because I talked to a father who's got a daughter going there last year, my school is between 50 and 60,000 per year.
Wow.
And if they're still making $10 doing what I doing what I used to do, like how does that math? That math just is not math. And
What
most
it
people
is, it's a lifetime of financial servitude and bondage. That's what it is at the end of the day. Like you can't dig your way out of that. You have to either change industries just to get out of the debt.
And the reason I brought up, hey, did you know what the US Uncle Sam's number one asset was and it being student loan debt? Like when we start looking at that and we look at what's going on with credit cards, we're going to get into all this, but there's misalignment throughout. There's misalignment between the system and how it's set up and then how we're told we're chasing this American dream and what it actually feels like for people.
Yeah, because here's what's kind of interesting, right? If we're looking at it and we're identifying the patterns, if we're noticing patterns, then we can actually do something about it. So
Yes.
that's what we want to really do today. It's like do a pattern interrupt. We're going to do a pattern interrupt. We're going to kind of expose a little bit of the how these statistics start coming into place and what money patterns you might have that are perpetuating this problem.
And before we do that, there's one more statistic that you haven't shared yet before we start jumping into this, right? How much, 40% of Americans, how much could they cover without borrowing if there was if there was an emergency?
Yeah, $500.
Think about that, $500. And how far does $500 go today?
It's I think it's one, maybe two tires on your car.
Depends on your vehicle. You're not putting one or two tires on my F-150 for $500, I don't think.
You're also
So
not fixing, not replacing AC units. I just had a $3,000 bill a week and a half ago on another AC unit. Man,
That
these
was
AC
it.
units are getting torn up in the South.
That was actually the pattern, Jeremy, right there. An AC unit and a transmission on my truck when we first moved into this house that started exposing my patterns and had me start asking different questions.
Hmm.
Because I did all the things that we're talking that you guys are doing, a lot of our listeners are doing, right? They're responsible, they're working hard. They're making more money than their parents did. They're saving money. They're putting money into retirement. They're putting money for their kids' future. And still, when emergency happens, we don't have enough to really cover it. So,
So if we're looking at all these statistics, Jason, and we're kind of looking at historicals, right? You mentioned a little bit about a savings rate. You mentioned that we're currently at a savings rate where people are keeping less than a nickel of every single dollar that they make. What were they making back in like the 70s or 80s?
a lot less than they're making now.
No, when I'm talking about the savings rate.
Oh, what were they saving back then? They were
Yeah, what was
saving
the
an
savings rate then?
average of 15 to 20%.
Wow.
1975 savings, a year after I was born, 17.5% savings.
Holy smokes. It's way different.
Way different. I mean, they're saving, almost two dimes, right? For every dollar.
So do you think it was, if you're looking at that going from 17 and a half down to 4%, did the average American just become less responsible?
No, no. I mean, if we crack this code during this episode, this will be the most viral episode ever because this is something I've been putting my head around for a while. No, that's not what happened at all, but something did shift and something shifted in a major way, right? Like to see the patterns go where they are. And some of that we're going to get into just with a statement after 9/11, right? From the leader of the free world. And when I saw that quote after I read that book, Jeremy, I was shocked. So,
What statement what are you talking about?
what well, after 9/11, George W. Bush came on and he said, "Don't let this terrorist act keep us from the malls. Don't keep us at home. Make sure we can go out and spend money. Keep consuming, people. Don't stay home."
Hmm.
Like, so that's like the culture, right? The culture is, hey, what are you going to do on the weekends? We're going to go out and shop. We're going to go buy stuff we don't need. We're going to go keep up with the Jones. We're going to go consume, consume, consume. And everything's there to sell us stuff. Like that's a whole nother episode, but there's a lot of our subconscious that's being spoke to about either what I want or what I fear. And
Yeah.
so, right. So that's kind of what I wanted to like. You're asking me a big question. I don't have the whole answer to it, but I just feel like there's something misaligned when we start thinking about those statistics and then the behaviors that make those statistics so meaningful.
Well, one of the other things that kind of transitioned that is credit became a lot easier to get, right? That little plastic card that came about, right? If you wanted something and you wanted it overnight, well, what do? You finance it. You put it on a card. And then what happens? You take on additional interest. You can buy it now with the idea of I'm going to pay it off later.
Yes.
But we had a previous episode about this with the whole marshmallow experiment, right?
Yeah.
Delayed gratification. Successful people have delayed gratification.
I'm
If you
hungry.
don't have the means to pay it, why put it on a card with the idea of paying it later? If you don't have the proper money patterns, you're probably not going to pay it later, right? So that's kind of becomes the path of least resistance here. When credit became easier, when it was everywhere, when the idea that, hey, you can buy it now, get it, and pay for it later. Oh, and Amazon stepped in and literally gave you overnight delivery, put everything else at your fingertips, that consumerism. So I don't think it's necessarily people becoming irresponsible. I think it's people having faster access to capital. That's what it was. And it's not necessarily their capital. It's capital that they're actually borrowing. It's capital that they're putting on credit cards.
Yeah, and you hit it perfectly with the delayed gratification piece, the marshmallow experiment, because that's what it is. It's like when you're in front of something and it smells good or looks good or you think it's going to make you look better, you're like, I want it, I need it, I got to get it. And if you don't actually see money leaving your wallet, your life, and you swipe it, little card, hey, it's easy, right? It makes it easier. It makes it easier not to delay stuff. So,
Yeah, so now we have a generation of hardworking people. They're all capable. Technology makes things easier, makes things that actually your work output and the dollar you get per that output is a 10, 20, 30 fold than what it used to be growing up. But it's also easier to lose your money, right? To these kind of money patterns that we're talking about. So even though you can produce more output with less labor, you can actually get paid for doing less because technology has increased your work output. You also have the ability to consume more at a higher, faster rate. So it's not necessarily irresponsibility. I think it's kind of a pattern that or a system that we were kind of given and the one that we're thrown into. You got so much marketing around. Like, how do you say no to those little gold and silver and platinum cards coming in the mail, right? I mean,
Yeah.
think about it, Jason. Am I crazy on that?
No, no, not at all. I mean, I was watching the one last night and knowing how Connor and Patty think, and I was watching the Amex and how, they have the most lounges, nice lounges at all the airports where you're always at, Jeremy. And the Amex card gets you in here, and the Amex card gets you in this restaurant, the Amex card gets you to the World Cup. And I was thinking, ooh, I need that. Like I literally thought that yesterday, Jeremy, just watching knowing my family wants.
So
So
why is it then that people who are making 60,000 a year and people making $600,000 a year have these same problems? Because people would just say, "Hey, if I have more money, I wouldn't have these problems." But if we also look at kind of the flip side, if I hit the lottery, why do people end up going broke within, 3, 4, 5 years? So is it really an income problem or is it a lifestyle problem?
it's a pattern. It's a lifestyle pattern.
It's a
You know,
pattern.
it's a
Okay.
lifestyle pattern. It's the pattern of if you're only saving 4 cents of every dollar you make, it doesn't matter if you make 400,000, 600,000, 60,000, right? You're not paying yourself first. You're not following the first law of wealth. I used to say this all the time, but there's two pains in life. There's a pain of discipline and there's a pain of regret. Now, when you're just swiping quick and when you're buying into that consumer model, you're not practicing discipline and you're going to therefore have regret because you're not following that first law of wealth, right? You're not following that, hey, I got to pay myself first. I got to take care of my house and stop being last in line for my money because if we're not seeing the system, Jeremy, we're not seeing that every time that we swipe the card, every time that we're paying interest to someone else, there's someone else that's making money off of our money and making a lot more money off of our money than we ever do because we're missing that first step of discipline.
Discipline's the key word there. And this is where I will give Dave Ramsey a lot of credit because in his baby steps, literally the first 3 steps is literally building financial discipline. Save $1,000, eliminate debt, build an emergency fund, 3 to 6 months. So I will give him credit because I think that's the key is discipline and just learning to save $1,000, aka increase your savings rate above 4 cents on the dollar. That is the start of breaking the money patterns.
Yes, that's it. And that's it. And I mean, if you don't take anything more than that away, just start implementing that first step of paying yourself 10%. That means that some other things, Starbucks, maybe some other things that you're doing are not going to be able to be done because you're going to start valuing yourself more. But give yourself the reward after doing that for a while. I know that wasn't part of this episode, Jeremy, but that's just something I thought like if we're going to break the pattern, we got to tell people what to do first.
Yeah, you got to pay yourself first. Like you said, it's this first law of wealth.
That's it.
So pay yourself first, and then, I love that book, Richest Man in Babylon. Pay yourself first, pay yourself with interest.
Pay yourself first, pay yourself with interest. And the more you can pay yourself, I mean, the wealthiest family since 1910, Jeremy, we've mentioned this statistic before, but they're averaging almost 38% savings.
Wow.
That is vastly different than 4%.
Significantly different.
Yes.
And think about this too, that margin, not only are they getting an extra 34% that they're saving, they're likely reallocating that into income producing assets and then
Yes.
layering in tax strategy to keep more of what they make.
And it all starts with discipline because if there's only two ways to make money, it's either man or woman make money or money makes money. So by having the margin, now you can start putting the money to work and you're prepared for any kind of emergencies you have.
Yep, absolutely. So when I'm looking at this, by and large, I would ask our listeners, has your income actually increased over the last 5 years? The answer is probably yes. Even if you're on minimum wage, your income has likely increased over the last 5 years. But has your financial security also kept pace with the increase in income? And if it hasn't, you have to start asking why. Is it something that you're going to blame on the environment, or is it something you're going to take personal responsibility for? I would venture to say you were given a system. That doesn't mean you have to inherit said system. You can break the money pattern. So how do we start doing that, Jason?
We start breaking the money pattern by doing what we're talking about right now. We start following the laws of wealth, right? Like, let's talk about those laws and how we can start beating the system. Is we have to, one, well, how about this? Let's figure out first where we're going.
Okay.
Let's figure out where we're going, what we want, and what's most important to us because we need something to anchor back to keep us disciplined. Like discipline's not something that every day, it's a decision that you make one time and you say, "Hey, I'm no longer going to feel like this. I'm no longer going to feel like if something happens, I can't take care of my family." Or if my air condition goes, I got to take off my shirt every time I go somewhere and put it next to me in the seat, like I did when I first moved to Florida, because I couldn't
Mhm.
afford a new air condition. You're like, I don't want to do that.
Yes, it's pain, right? That's what you're saying
Yeah.
is the pain, really, the financial pain, the stress, the uncertainty is what typically forces someone a pattern interrupt. We have this idea that success, that once we're successful, everything's going to be easier, that we'll have more time. But I would argue that success, once you achieve success, it's actually an illusion that you'll actually have more time too. Think about that for a moment. I will get to this once I'm successful. So what do? You
Yes.
keep putting these things off. But also, I've found the flip side. People who are successful, to your point, that people making 400, 600 million dollars a year still have the same money patterns. Why? Because success creates the illusion that there's going to be more time. We only all have the same 24 hours in a day. We don't all have more time. It's an intentional decision to interrupt the pattern.
Every time. And so that intention is what is the pain you're moving away from? Because that pain is usually going to be your indicator of something you don't want in your life. So if you need, like Jeremy, if I asked you this question, like Jeremy, imagine that you, and I know how much you're working and everything that you're doing and building, and I'm very, I admire and tell you how much I admire what you're doing all the time. But imagine that we're 3 years from today. And for everyone listening, this is your question too. Imagine we're 3 years from today and you were exactly where you currently are still. Nothing changed for better or for worse. It was just, you're exactly where you are. Like, how would you feel?
I mean, livid would probably the one and only word I could use to sum it up, right? To know just that you work and grind and punish yourself and save and sacrifice, and yet it doesn't feel as though it's enough, right? Well, who's actually responsible for our own lives? It's us at the end of the day.
Yeah.
So if I'm still in the same place I am 3 years from now, the only person I have to blame is me myself, because we live in the most free country there is. The opportunities that are here, you got kids, teenagers making millions of dollars on social media, like it or not. Capitalism is alive and well in this country. So the ability to earn more income and to reproduce yourself time and time again, it's there. We have the ability to create more income. My next question is, how do we keep more income, right? So we know how to create. How do we keep? And then once we learn how to keep, then we can multiply.
Yes. And let's get into that. I mean, I wanted you to feel that question. So, anyone listening, I hope you did the same exercise, Jeremy, because I know if you're listening and you're a builder, you're working hard, you're hustling, you're doing the things that maybe are a little uncomfortable to have that outcome. And whatever the story is you're telling yourself, I'm doing it for myself, for my family, for my future, for my grandkids, whatever that is, it that is part of the pattern. And that's why I wanted to bring that up, Jeremy. That is part of the pattern of what the stories you're telling. Because you made a really great point. It doesn't matter if you're the president of the United States or someone working in a 9 to 5, you have the same 24 hours.
Mhm.
And it's not going to increase when you have more. So if you want more, have more intention around where you're going and then start using the laws of wealth because they're laws for a reason.
Their laws, they're not anything new and they're not complicated. We actually have a whole other podcast literally on all seven laws. But
That's it.
let's just break down the first three. Let's not recap that episode. Jason, let's just go with law number one. What is law number one?
Law number one, pay yourself first, right? Just 10% at least a minimum of 10% off the top. Be first in line for your money, right?
Yeah.
Most people never do that. They're paying everybody else and they're last in line. Builders, we flip that order.
Yeah.
What's number two?
Well, hang on. Let's give them a how to, because I don't
Okay.
just want to say pay yourself first, pay yourself 10%. Okay. what is a way that we can actually do that? Again, technology's here. We can automate it. One of the ways that I started paying myself first was literally automating it. On the first of every single month, I set a goal. And that goal, I could not see that money. That money went out of my account directly into a different account. So that way I couldn't actually spend it. I would say here's another way that you could do it. If we're trying to get our spending under control, stop getting American Express credit cards and things with unlimited balances. Literally give yourself a spending budget. Use that card that maxes every single month. So if you do two things, let's just give you two practical examples on how to pay yourself first. Number one is automate it, literally automate it, redirect it into an account that you can't touch. Ideally, it goes into at least, in the bare minimum, a high yield savings account, right? You don't want it to go into one of these accounts that pays 0.01%. There's a way that I automate myself, my payments, right? We'll get into a little bit of that strategy. It's a forced savings vehicle. But another one is if you're going to be paying yourself, 10%, you're going to be automating it, but you still have that money pattern and it's very hard to break. I would recommend there's a book called Atomic Habits. It starts small, but let's just jump into it and say, give yourself a credit card with a cap. And that cap, you can't spend more than X dollars every single month. You set the budget, you set the limit. That is your spending money. That's your fun money. That is go out and blow it money. I don't care because I do believe that you have to enjoy life. This is what I don't want people to do. I don't want people to walk away from this episode and say, hey, I can't actually have that Frappuccino from Starbucks. I can't actually end up, taking my kids out to a ball game. That's not what I'm saying. Life is short. You need to enjoy it. But we also need to make sure that we're setting our future selves up for success because at the end of the day, you don't want to be in the same spot 3 years from now that you are today. So law number one, just to recap, pay yourself first, pay yourself 10%. Law number
Automate
two,
it.
Jason,
Automate it.
automate it, baby. Automate it.
Automate it. Automate it. Have a separate account that you is not easy to access. Make it hard to access that money. That's the point, right? Number two is to spend less than you make. And the beauty of this one is you want to create margin. And what do I mean by margin? I just mean that if you're saving 10% and you have to save another 10% to create the margin to protect that 10%.
So you're saying go over and above because
Over and
there's going to
above.
be there's going to be times that you're going to dip below 10%. So you want to create a buffer.
Correct. You want to create a moat around your money. Because again, if your goal is not to work your whole life, at some point you're going to have to be able to put your money to work.
I like the idea of definitely, spending less than you earn. That kind of goes back to what I said before, of putting that credit card limit on there, right? Whether you put a limit, you're automating that process too, because you are going to spend less than, so long as the limit is less than what you make, right? So there's a little asterisk next to it. But the idea of creating margin, that buffer is also important because it does two things. Let's say that you have a bad month and you do go below your 10%. Guess what? You're over time, you're going to average out to over 10%. But let's say that you actually get the proper money patterns going down. You're saving 12, 15, 20%, and you're keeping up with your margin. Now you're accelerating that growth. Even if you're a Dave Ramsey disciple, right? That whole law number three, baby step number three of 3 to 6 months, you're accelerating that timeline. You're building margin. You're actually creating a peace of mind fund, right? And that's what that buffer is, at margin. So at the bare minimum, we want to hit 10%, but give yourself a little buffer, baby.
Hey, we're not hating on Daddy Dave either. We think these are some financial great ideas he has in baby steps. We're just telling you if you're going to do these, we're giving you ways to optimize. We're always looking ways to make things a little better. Jeremy said something in the last couple minutes. Oh, that's a forced savings vehicle. I'll tell you where mine goes. This is going to jump us right into law number three, right? This is where Einstein said, hey, this is the eighth wonder of the world. Jeremy, go ahead and hit law number three and tell us about your forced savings account.
Yeah, so it is compounding interest, right? So that's what we're looking at is compounding in and of itself. It's not financial theory. We know for sure compounding works, right? We see how compounding can multiply. So before I said create, we just spoke about laws number one and two, which is key. Now we're talking about multiply. When you have compounding, a dollar, compounded over time can create truly generational wealth. It really can. What about when it's uninterrupted? With your ability to compound absent of any sort of market conditions. So I don't care if the stock market goes up and down. I don't care about housing or cryptocurrencies or whatever emerging markets in the future. If I have the ability to compound uninterrupted, What does that do for my long-term peace of mind? What does it do for my long-term wealth building? Well, a lot of the builders in our community, we love to use high cash value life insurance. It is a forced savings vehicle. And when the cash value builds up, I'm able to use it for both opportunities and emergencies. So when the AC breaks, I can go fix it. I have a peace of mind fund. When an opportunity and I need a funded deal by the end of the week, I can tap into that. The beauty of it is I've leveraged the death benefit, meaning I can pull the cash value out. I can respond to an opportunity. I can respond to an emergency. And my cash value continues to grow and compound in the policy because the death benefit was effectively the collateral. If something happened to me, my death benefit is reduced by the outstanding loan amount. So mechanically, that is more or less what's happening in very simple language. That's why I like it. It's a forced savings vehicle, but it also produces wealth today. And then for my family, because the wrapper is whole life insurance, it also produces generational wealth beyond me.
So you're giving your money multiple jobs by following the third law of wealth. We're just telling you a more efficient, or maybe I like the word optimal, way to do this, where you can create this and you never interrupt the compounding. So if you are a good saver, if you do follow law number one, if you do create a margin, well, then the next question becomes, well, where can I store this where it can do more for me? Jeremy mentioned a high yield savings. That's a good place. But you have, when you borrow against that, guess what? You interrupt the compounding. We want to, this is the way that you can use this to never interrupt the compounding.
Do you know where most people's forced savings vehicle is, Jason? The average American family, what is their forced savings vehicle?
I mean, based on your question, I'm going to guess you're going to say it is their retirement plan,
No, it's actually their house
their
because
house.
you have to pay the mortgage every single month. So
Hmm.
you're building equity over time.
I did see that in the shocking statistics. Now you brought it back to me.
The policy in and of itself is very similar. It's a forced savings vehicle. When you fund your premiums every single month or year, you're effectively creating equity inside of the policy. What's great is it earns dividends, it earns interest, and it produces a death benefit. Your house, on the other hand, how do we tap into equity in our house? Well, we use a HELOC. The problem with the HELOC is those interest rates are variable, they're not locked in. You're also putting risk around the very fabric, your security, your house in and of itself. So if you miss a payment, they can foreclose on you. Whereas if you miss a payment in the policy, Jason, what happens?
Nothing.
Yeah. So if you borrow from yourself and you don't put the equity back in, what happens? What you're truly doing is you're stealing from your future generations, right?
Yeah.
Because it reduces the death benefit, reduces the protection amount. But here and now, no one's come knocking on the door. You have to answer yourself.
And so now that we know this, we went over the statistics. We went over where 70% of people are paycheck to paycheck. People don't have $500. And now we've shown how you can shift that pattern. So what's next, Jeremy?
What's next? Well, knowing's not enough, I would say. All right. So you have education about this, but a lot of people, unless they actually feel that this is important, unless they're trying to move into a different direction, they're not going to do anything about it at the end of the day. So let me ask you something, because someone listening to this right now already knows that they should save more, right? They already know that, hey, debt's expensive, especially credit card debt, student loan debt, all of that's very expensive. They probably knew a lot of this before our episode actually showed up. So why is it that knowing's not enough? Well, it's likely that the pain of saving isn't here and it's not in front of them, right? The reward that we're talking about, typically we're saying, hey, reward yourself 10, 15, 20 years down the road, right? Pay down your debt. Well, that feels like we're losing a lot of money today. Building a reserve, it feels like something like we're giving something up today. Consumption, what does consumption do? That's immediate gratification. That's our marshmallow experiment. Building, though, building feels different than waiting, I would say. It's an entirely different culture, and the culture is really designed around what do we want to create for ourselves. I would say the peace of mind today. I want peace of mind for myself. I want peace of mind for my family. I also want to reward my future self. Because 3 years from now, if I'm still feeling the same way that I feel today, I'm going to be miserable. I'm going to be livid. So we're not trying to teach new information. Jason, what we're trying to do on this episode is help you re-identify as a builder. That's what we're
Yes.
trying to do.
To help you make that decision. Because if you're listening and this resonates and you feel like that's me, that's how I feel. Like I don't want to feel this way 3 years from now. Well, you don't have to. Like Jeremy, you and I were here at this place years ago, right? When we discovered this, and I said, I can't keep doing this. I felt
Mhm.
like I was on crazy pills, is what I used to say, but it could be it could be a rat race as well, or a treadmill, or however you want to see that visual or feel that visual. I've had people tell me, Jason, I don't want to keep hiding in the closet when I'm making 200K a year, and I feel like I can't take care of my daughter, I can't take her to these trips, and I just can't keep doing this. Well, then let's do something. Let us show you how. And how do we help people get to that next step? What does people need to do to see how this works and can be applied for them?
First thing you need to do is just ask for help. Like literally, just raise your hand and volunteer. I need help, right? What does that look like? Well, you go to wealthwisebanking.com, you book a call with Jason and myself. What we'll do is we're going to look at your holistic picture. It's very simple. We're going to look at where you are today and where you want to go tomorrow. What is your current savings rate? Hey, what capital do you have already set aside for emergencies? Hey, how are you responding to opportunities? I asked a family the other day, they're in their 60s. I asked them, it's like, hey, if the AC broke in your car like next week, where's the money come from? He said, oh, my TSP, my thrift savings plan. I was like, so from your retirement vehicle, what does that do to interrupting in your retirement? Because I actually want to preserve your retirement, right? You should want to preserve your retirement. So why are you setting yourself up for failure? Because you're already in your 60s, you have RMDs right around the corner, you can't afford an interruption. So if this feels like it resonates with you, if you want to have someone just literally look at your plan and give you peace of mind, hey, am I on track? Or could I use a little bit of help? Hey, does this legacy piece actually matter to me? Or do I need access to income and capital today, right? What's the protection look like? Just book the call, wealthwisebanking.com. It literally just starts with volunteering. That's it.
That's it. When you get past the ego and say, "Hey, I just need help." We've helped thousands and thousands of people. Book the call, go on wealthwisebanking.com. And Jeremy, you're already in banking.
You're just not the banker yet. So book the call.
All right, all. Be blessed. See you on the next one. Thanks for joining us on WealthWise Banking. If today's episode inspired you, please subscribe, leave a review, and give us a like. It's a simple way to help others discover these empowering strategies and join our community. Together, we're building a network of people who believe financial freedom is within everyone's reach. Remember, financial independence is about making every dollar work for you, one step at a time. Until next time, stay inspired, stay in control, and keep building your legacy the wise way.